Joined by Maulik Patel, Head of Research at Aquarius Securities this afternoon to give us a perspective on how he's viewing markets. Maulik, very good afternoon. This is Harsh here.
Good afternoon.
Maulik, let me first start off by setting the context. Generally when we've seen these kinds of conflicts emerge, at least in the last maybe 5 to 10 years, we've seen, and more so in the last 5 years, we've seen them as great opportunities to buy. Would you reckon this is the point, or would you wait for some more clarity on what's emerging out of everything that's playing out?
So I would wait for a couple of days for things to settle down. Now, this kind of crisis, particularly what we are seeing today, is different from the, let's say, 10, 15 or 20 years, right? It's more similar to the first Gulf War in 1991, when between Iran and the coalition forces, but it's not that bad like what we saw in 1973 when there was an Arab embargo on oil export to the Western nations, and in that case the price moved by almost 300%. In case of 1991, the price moved double for 3-4 months before even the war started, because there was a buildup of military assets, there was a coalition force. So market anticipated this, and then there was, even before the war start, just as soon as the war started, the price started correct down as market realized that Saddam Hussein is losing this war. In this context, if you see, oil started moving up already in the first or second week of January. Even if you look at a lot of passive money has moved to the oil and oil-related stocks. There is an ETF in US called XLE, which is up almost 22% year to date. So that's reflect that kind of a money which has moved in that. Now, if you ask me, the view is that the war should get over in a week. However, it's very difficult to predict the duration of war. And let me give you a perspective. When the Ukraine war started, most of us believe that the war will last probably 1 month at max. But we are in the 5th year of the war. And if you look at when the war accelerated in the month of March 2022 and April 22, the oil moved to the almost $120, $130 per barrel. So it was difficult to envisage that it will move so fast, but it did move. And at the same time, the market find the volume. The Russian barrel reroute from Europe to Asia, particularly China and India. Market stabilized, OPEC increased the production. And what you saw, that even the war is still going on, the oil has come down to $60, even I think last year, right? So here, however, it's a little different, given that Iran sits in the Strait of Hormuz, which is 20% of the global oil demand pass through that, 20% of the world's LNG demand pass through that. What we are seeing today, Qatar, which is 20% of the global and 18% of the world's liquefaction capacity, they have announced a force majeure. There's a real disruption is there. So in that context, probably we would like to wait for a couple of days how things are moving up, and then take a bullish view on market once we see the regime is collapse, or the attacks which are happening from the Iran getting reduced day by day, and then we can make another constructive call on the market.
If I were to shift backwards a week or two ago, IT and AI was the big talking point, right? Where do you sit with regard to that argument? Do you believe AI will disrupt IT, or will IT be able to hold on and, in fact, maybe even extract its pound of flesh in terms of additional services which it could sell as due to this entire AI wave that's come through?
I think AI without a system integrator or like Infosys, SCL, that's not possible to develop in enterprise customers. You can have AI for retail, the way you and I use the ChatGPT or Gemini or few other. But for enterprise to use it, they need customized. And the customization will be done by the system integrators like Indian IT companies. So that's now the question is that the market, what to say, the sell-off 2-3 weeks back is that not related to the near-term earning. Is that what would be the earning trajectory 5 years down the line? In near term, you may see earnings moves upward because there's an accelerated development of the AI across the enterprise, and in which the IT sector services or the products can be meaningful use, and we may see that. However, the call is still the same. What will happen to the earnings 4 or 5 years down the line? Will there be a deflation in the pricing given that kind of a productivity gain delivered by the AI? So that's what the real question or the concerns among the investors. And but however, if you take on a very common investor or common investment, is the pendulum moves both sides, right? So we are seeing in the pendulum moving extreme fear on IT. The valuation has become reasonable for the many of the large cap, and you see the rupee has depreciated by almost 2% in the last 2 days. So we will see some kind of buying emerge at an IT stocks, given that they're relatively safe in this disruption period. What you see also in this last 2 days, the South Korea is down by almost what 20% or 15%, right? And it's still up 20% year to date if you look at from that. So that kind of craziness has seen in a South Korean market, partly because of the memory prices going up. That's again related to the AI. So that trade is getting reversed very, very fast. We will see some buying emerge at Indian IT companies.
Very interesting. Okay, so you could start to see that unwind play out on Indian IT is what Maulik's view is. Maulik, curious to know, therefore, at this point, if in the next day or two, if things do get better, what are those sectors or pockets which you believe are very good opportunities at this point, ex-IT? What is it that you would really bet on?
So where we will bet, obviously, where the stocks have fallen the maximum. If things can get better, if the flow in Strait of Hormuz restart, if the Qataris start LNG production, obviously the one which has fallen the maximum are HP, BP, GAIL, PLNG within the energy pack, which we will like it a lot. Some of these high beta stocks like in EMS that have also fallen a lot, like Dixon, which can be again play on a reversal of memory prices, which is again linked to the IT. We may go for on a high beta in metal because some of the metal stocks are still, I mean, metal prices are still at an elevated level. The stocks have corrected because of the leverage positions, the fear factor. So that we probably will like it. Cement. Now we are entering into a peak cement demand season perspective, and cement stock was also corrected in anticipation, and because of the higher oil price will lead to the higher petcoke prices and the higher cost for them. These are the few of the names we will definitely go and overweight our position.
And Maulik, what is it that you would absolutely avoid in this market?
There is no absolute nothing. I think we probably will avoid some of these pharma companies which are largely dependent on in the US generic market because of the kind of competition, any kind of competition they will see in some of the key drugs. That's the one sector we will avoid. We'll avoid FMCG at a certain extent, given that there is no incremental earning, positive triggers are there on those one. So these are some of the names which, obviously in capital goods, some of the names are still very expensive. On the defense side, obviously, whenever the conflict starts, that the defense stocks make a very big move. But some of the defense names, which are the multiples, are still at a very, very elevated level. We'll avoid that.
Okay, Maulik, thank you so much for coming in and speaking with us, giving us that perspective on a day like this, kind of contextualizes things.